Hi, welcome to Investment Analysis and Portfolio Management course. The title of this module is Market Efficiency. The section goal is to understand the portfolio theory and asset pricing models, and the module goal is to understand the concept of market efficiency and its form. The efficient market hypothesis is the concept of efficient market theory, which is a hypothesis that states that share price reflects all information. The efficient market hypothesis maintains that all stocks are perfectly priced according to their inherent investment properties, the knowledge of which all market participants possess equally. So, in efficient market hypothesis, prices of securities fully reflect available information, and investor buying securities in an efficient market should expect to obtain an equilibrium rate of return. In addition, stock price should follow a random walk. What is the random walk theory? Random walk theory suggests that changes in stock prices have the same distribution and are independent of each other. Therefore, it assumes the past movement of trend of a stock price or market cannot be used to predict its future movement. Next, we're going to discuss about competitions as the source of efficiency. First, within firms, competition acts as a disciplining device, placing pressure on the managers of firms to become more efficient. Secondly, competition ensures that more productive firms increase their market share as these expense are less productive. In the market, information is the most precious financial commodity. Then strong competition assures price reflect information. When market comprise higher investment returns, it motivates information gathering. Diminutive marginal returns on research activity suggest only managers of the largest portfolios will find it useful pursuing. There are three forms of efficient market hypothesis. First is weak form, second is semi-strong, and third is strong forms. Weak forms asserts that stock price already reflects all information contained in the history of past prices. Semi-strong form asserts that stock price already reflects all publicly available information. Strong form asserts that stock price reflects all relevant information, including insider information. To test the semi-strong version of efficient market hypothesis, one can see if a stock price gaps up or down when a previously private news is released. How about if market is efficient? Even if the market is efficient, a role exists for portfolio management for diversifications, tax considerations, and risk profile of investor. For example, investors of different age have different degree of risk aversions. An efficient market is one where the market price is unbiased estimate of the true value of the investment. But there are some conditions. It does not require that market price always equal true value. It does not require all assets have the same expected return, and if one investor outperforms the market for an extended period, it does not necessarily mean markets are inefficient. It is also possible that some markets are efficient while others are not. Another important concept that we are going to discuss here is behavioral finance. We start with a world that is perfectly rational and with no frictions that inhibit arbitrage. So prices are rational since all investors are rationals. If we introduce a small number of irrational investors, then what happens to prices? The irrational investor makes suboptimal decisions, and the effect on prices is likely to be both tiny and transitory. Now, assume there are few rational or we convert almost all investors to irrationals. What happened to prices? The remaining rationals now have lots of arbitrage opportunities and mispriced securities. Over time, the rationals should gain capital so that the rationals come to dominate the market and set price at the margins. There is now some mispricing. but not very large or very persistent, since there are still a handful of rationals in the market with the ability to place large trades against mispriced securities. Underlying the notions of efficient markets is the belief that investors are mostly rational, and even when not so, that irrationality cancels out in the aggregate. Psychology research points to some systematic behavioral bias, and most investment philosophies try to exploit one investor irrationality or another. Thus, behavioral finance is an area of study that proposes psychology-based theories to explain market outcomes and anomalies. Technical analysis can generally be viewed as a search for trends or patterns in market prices. It is a branch of behavioral finance that studies collective investors' psychologies or sentiment. Technical analysis assumes prices follow predictable trends. In addition, technical analysis tend to view these trends as momentum or gradual adjustment to correct prices, or alternatively reversal of trends. So let's have a quiz for this material. The main difference between the three forms of market efficiency is that A. The definition of efficiency differs, B. The definition of excess return differs, C. The definition of price differs, and D. The definition of information differs. So this is the end for this module. See you later.